we look back at certain tasks that people had to do during the Industrial Revolution or during feudalism on farms, and we're like, oh God, that'd be horrible to live your day threshing wheat like that. I think hopefully we can look back on a lot of jobs that exist today that are repetitive, that I don't think can lead to human thriving, and say, I can't believe we used to make people do that. And hopefully we find new things for people to do that is uniquely people.
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
This is a real episode. Not in the sense we didn't use AI, which, by the way, no AI was harmed in the making of this episode. But this is an episode between two human beings. Jake's shared things like his tough past on this episode he's never publicly shared before. And yes, I can verify. I've listened to all the public talks and podcasts he's been on and read all of his writing. We peeled back layers of the onion, many, many layers. For those of you who don't know, Jacob Miller co-founded Opto Investments with Joe Lonsdale and Matt Reed, the solution for wealth managers to efficiently build and manage differentiated private investment programs. Prior to 8VC and Opto, Jake spent years focused on fixed income and client services at the legendary Bridgewater Associates. He's got a wealth of experiences from having worked in a hospital in Sri Lanka to a fintech banking startup in India, just to name a few. And you'll see it in this episode. How do you balance storytelling with portfolio construction? What is the difference between a GP having an opinion and a GP having insights? How do you get to the bottom of the truth when you're underwriting venture capital managers? There's no better way to describe the gravitas of this conversation than for you to witness it yourself. So everyone, welcome Jacob Miller.
Thanks for having me. Looking forward to it.
You got into investing when you were 8 years old. And my question to you, and I'll buy you some time, is why are the markets interesting to you at such a young age? Because forgive me if I'm being too forward here, but I kind of don't get it. At 8 years old, I'm playing with Legos. I'm reading fantasy novels. I'm playing ball with the boys. And I never in a million years would have had the foresight to be in the position that I am today. I didn't even know, naively so, what an investor was. What am I missing in Jake's story?
Well, so going back to the storytelling, it's easy to look back now and say, well, of course he was doing that then because he ended up here. Mm-hmm. But I was also doing a lot of other stuff I'm not doing now. I was playing a lot of music. I still do that as a hobby, but it didn't lead into anything. But if that's where I'd gone, we would be telling the story of piano lessons at age 5. And so there's the confirmation bias of that. Don't get me wrong, I was also building a lot of Legos. But I've always liked games, and I think it was just a different kind of game. This was not me thinking about the wealth aspect of it or this being a career. I just like complex games, on the Computer Civilization or Risk on the tabletop, and it just kind of felt like another thing like that. You have a lot of information and a lot of things that go up and down, and you have to pick the right things. And don't get me I was not doing a good job of this at all, but I started paying attention and learning stuff. And as I learned more and that developed, it just struck me as this thing where you get to learn a little about almost everything. And I don't know, there's a kind of beauty to that, which fertilizer is being used in Ghana and what is happening with electrification of cars in China and what beauty products are being produced in France and how much Americans are driving versus flying, all in their own way impact the price of oil. And they aren't going to disentangle every one of those things, but you get to think about all of them. And so this kind of I'm very easily distracted. I like being able to jump around things, and the fact that markets sort of push you to be that jack of all trades versus hyper specialized was very in line with my brain. And we cut that expression off. The original, so we say jack of all trades, master of none, as if that's the bad thing. That expression is supposed to be, the full expression is jack of all trades, master of none. Surely that's better than master of one.
This is why you studied classics, didn't you?
That was a bunch of reasons there. I've always been interested in history. My grandma was she was actually denied getting her PhD in anthropology because she had kids, and this was a time where the world is still not great to when they were trying to work and have kids, but the PhD director at USC said, no way. But she took her love of anthropology and started a travel agency around like tours of ancient sites and digs. And so I grew up going on those tours and seeing ruins and getting to know people over the world through that. So I always had a love of ancient history. I think there's like a pattern recognition to piece to history that I've always loved, of like what has always been true, and it's just kind of these patterns repeating themselves, and how do you abstract and build your ontology and framework. And then part of it was related to the mental health thing. This was before it was hip in Silicon Valley, but found the writings of Seneca in particular, and the Roman Stoics, and just found a guidebook for how to, like, it's not a philosophy in like sense of Kant or even Plato. It's a guidebook on how to live. And I mean, they were the progenitors of what's now CBT essentially, and they were saying, look, you have pre-emotion, you can't help that. Then you have emotion, which is when you put reason and emotion together. Don't do that. And so got obsessed with that, and then wanted to be able to read that in the original. And so once I was learning Latin and doing the classics, figured might as well go all in there.
Are you still reading Seneca's teachings every morning?
Right here.
Is it still in Latin?
I cheat a little bit. It's got the Latin next to the English. So I try my best, and when I don't know words, I let myself go over to the English side.
That's so smart. I apologize to everyone listening on audio. What Jake just did was a show and tell of the book he reads, the Seneca's teachings every morning. So going back to an earlier bookmark that I mentioned earlier, which is like the idea of like stories we build for ourselves, or how we build portfolios. For better or for worse, the human race runs on stories. And in the private markets or public markets, or just in the investor base, these stories aren't often called stories. They're often called theses. They're called strategies. You mentioned earlier about the downside for believing in a story too much. Where's the happy medium on the either end of the spectrum, somewhere in the middle, I imagine, where people should take stories as they are?
I mean, I think the important thing is just knowing what the assumptions are that underpin your story, so that you know when you might be wrong. I need to actually go back and find this study. In some psych class I took in college, the professor said something along the lines of like, if you didn't have stories or branding, it would take you, so like 4 hours to choose which cereal to get based on solely merit. If you read you did cost comparison versus ingredients, nutrition, et cetera. Like, you need the story to be able to make a decision in 2 seconds rather than 6 hours. And so they're not bad. They are force multipliers that help you move faster. But you need to know what are the assumptions that underpin those stories, so that you can know if and when they've been invalidated. And so it's not don't use them, but it's one, understand from a first principles perspective the framework that is driving that story, and understand what you would look for to know that you're wrong. And also, like, stories can be true for a while and then not true. And so, like, know like when that story might end and when you have to reevaluate. And really, it just comes down to the framework for me. Like, you have inputs, you have framework, you have outputs. The story is the output. You can be wrong on your inputs. You can be wrong on your framework. Better to be wrong on your inputs than your framework. Because if you're wrong on your framework, it's garbage. Well, it could be good in and garbage out. You don't even know. These are things you can update. You can go look at the world and say, oh, that fact that I thought was right, GDP was revised, or this market is now more open, or that input I had has changed. But if it's going into a machine that doesn't make sense, the output's never going to make sense.
If we could take one example of one of Jake's frameworks and to break that down into inputs, framework, output, could you walk us through the scaffolding of that? And if you don't have one that immediately comes to mind, I could give you one that I've heard previously that you've mentioned.
Yeah, I mean, one that I use every day is I have a very simple framework for what alpha is. And so people talk about alpha a lot of different ways, some ways that I don't think really help you that much, which is like assume a beta and it's the residual. I like to think about it as like there's this thing called market return, which is basically on how much are people who need capital willing to pay people who have capital.
Uh-huh.
And they have this thing called alpha, which is return that's driven by skill, not by market return. And when you start to think about, well, what does that mean? Skill means you're doing something other people aren't. You have to be different than the average. What can drive that? How are you going to have that be positive expected value? You need to have unique information, unique insight, unique access, or get uniquely lucky. As investors, we probably don't want to bet on getting uniquely lucky. And access and information constitute insider trading in public markets. And so if you're going to be a public market asset manager who claims to have alpha, you need to be defending why you have unique insight. Why can you take information that everyone else has and derive conclusions that other people won't? Which is a very high bar. There are a lot of people trying to make money in markets. There are many, many people employed to price stocks and bonds and assets and trade macro and close market microstructure gaps and all these things. And it's just a very high bar to get over. And yeah, it raises my bar of skepticism if I'm evaluating a public market manager. You have to go a long way to convince me not only that you are more insightful than the market, but that you are getting more insightful every day, at least as fast as everyone else, if not faster. Because otherwise it's just going to decay over time. But in private markets, we can look to what are sources of unique access and information. Are you in founder networks that other people are not in? How can you show me that you see deals before other people do? Do you have benefits as an LP or GP that you can bring to founders that might lead to preferential pricing, that would lead to them choosing you first? Do you have a reputation that is going to attract the right kind of talent? And then hopefully on top of that, do you have really insightful frameworks about what makes a great founder, about how to assess TAM, about how to help a company scale through product market fit to expansion, et cetera. But like starting with, I always start a private market analysis with like, let's talk about access and information. What do you see that others don't? What do you know that others don't? And that's an easier thing to really dig into than like a black box quant hedge fund strategy where not even the people overseeing that know exactly what the model's doing.
Do you have any examples of, let's say in the private markets, of people saying things that you believe in where they see things that others don't, or they know things that others don't? Do you have any examples that you've liked historically?
There's a guy, Pete Soderling, who runs the Data Council, which is a consortium of all the firms that do awesome data stuff. This was big data back in the 2010s. It's obviously a lot of AI and model and training stuff now. And he served as a mentor, connector, just facilitator of great conversations in that space, and has built a lot of trust in the community of like really deep thinkers and deep tech folks in and around data. And you can imagine that helps him see a lot of companies before they're even companies. Someone just has a random idea. They have a problem that they're working on. Okay, this might have more legs than I thought. And in terms of like connecting talent with the right ideas, in terms of even finding early adopters for new technologies, et cetera, like he's just right in the middle of it all and has built so much trust as a real data person himself. This isn't a financialist person just trying to make a buck. He's deeply passionate about this area, and that attracts in general the right kind of founder. But then there's other things like defense is a really hard space to crack. The procurement system in our country is totally broken. It's really hard to innovate, but not impossible, as we're seeing with a few of the upstarts now. And so finding VCs who have helped companies actually crack the Pentagon before. If you have the right technology, right idea, and right team, that actual go-to-market is going to be your hardest thing. You're going to choose to work with a VC that has shown that they know how to do that with other companies. And they're also going to have more data as the VC on what are spending plans for those agencies, what are the gaps, does this technology actually fill one of those? So you get these moats, which is why I think you see so much serial correlation in venture and private markets overall. It's not forever, but very often if you're top quartile, one fund, 3 or 5 funds later, you still are, with the caveat of if you're growing too fast and growing outside of what could possibly be sustained by your own unique moat and access to information, that tends to degrade pretty quickly.
How do you underwrite relationships? because there are so many defense, resilience, you name it, let's say American dynamism funds that are out there right now. And as we're recording this in 2025, it is the flavor of the month or the flavor of the year. Everyone's going to say they are deeply connected to XYZ. They have relationships here. How do you see who's telling the truth and who's stretching it a little bit?
Yeah, I mean, one big one is who was saying that before it was cool.
Yeah.
They probably actually have the relationships because that was a deeply unpopular thing a few years ago. And if you were saying it then, you probably meant it. You probably built some goodwill.
Mm-hmm.
Incentives matter. Do you have advisors or other people with, it could be even like employees you've hired with the right skin in the game to keep those ties really deep? And then also, I mean, just looking at how true that commitment is. Like, people can say a lot of things, then you scratch the surface and you're like, well, these are all, ChatGPT layer clones. Like, is this American manufacturing? I'm not sure. And so, looking past that storytelling into the details, does this actually do that? Has this story been something these people are telling for longer than it's been hip to say so? And are the right people around the table with the right incentives to keep that true?
How do you know if someone's been telling the story long enough? And I'll give you an example. I became an LP fairly recently in the grander scheme of things. And I meet so many AI funds these days who say, oh yeah, I've been investing in AI since 2014, 2017, and all that. And I mean, this is what they're telling me. And I'm not going to call them. I was like, oh no, you definitely weren't telling people that, because I didn't know them back in 2014, 2017, whatever that is. There are obvious elements of maybe they were on a podcast or they wrote a blog post. That is an easy piece of evidence, an external artifact where they were talking about this way before. But when people are just saying it, they don't have those public-facing artifacts. How do you know they've been saying it for a long time?
Depends on how long they've actually been doing it. So if you're in diligence and they actually had funds back then, I would always want to see, what the pitch decks and materials looked like in the years they were claiming that. Like, was this a theme you were talking about? Presumably it's somewhere in your materials if it was. Look at the highest conviction bets they've made. Were they in and around these spaces, or is it kind of, hindsight, Monday morning quarterbacking of like, yeah, every company's a little AI now. And then, I mean, look, you never totally know, but some of this also comes down to like how differentiated is their forward-looking viewpoint. Like, if they've really been in the space that long, hopefully they have some unique insights that others who are newer to it might not, in terms of which sector they're choosing to play, which founder networks they're choosing to back, which ideas they're bullish on versus bearish on. Like, if it sounds like, just pick on them because their reporting on this is very banal, but like, if it sounds like what Bloomberg's saying about AI, they don't really understand AI. Like, probably haven't been in the space that long and you haven't gotten yourself kicked in the butt a couple times and had a few successes and started to pattern match on what real is here.
A friend and I recently had a conversation where we were talking about organic wisdom and synthetic wisdom. Organic wisdom is earned by scar tissue, by experience. You've made those bets, you've made those mistakes. Synthetic wisdom is reading the Bloomberg terminals. It is, I love Peter and Carta, and I think he's doing a good job there, but reading like Peter Walker and his insights on Carta. It's reading the angel list reports, the pitch book reports, the prequel, you name it kind of thing. And it's not developing your own synthesis. And what I think is really interesting about that is sometimes when you just purely look at a deck, and Jake, if you disagree, feel free to push back here. When you purely look at a deck, you'll notice a fund manager goes like, hey, I believe in AI because XYZ reasons, and they cite a bunch of sources, and it's usually the most common sources, and they haven't done any primary research. It's all research they've borrowed from others. And to me, that is, and feel free to disagree, but I think that's an element of synthetic wisdom.
Too much source citing is honestly kind of a red flag to me. Like, this should be stuff you're learning in market. That's evidence of your unique access and information. If it's a report from McKinsey, well, guess what? Everyone knows it now. And also probably it's the people who, I wouldn't trust anyone who's using McKinsey reports to underwrite VC, but it's a separate thing. And And it goes back to the storytelling piece of like, is this your story or someone else's? Will you know when it's run its course? And you should, like, VC is all about being nimble. Like, you might want to pivot out of this focus at some point, but if you're reading someone else's story, you're probably going to be a little bit late versus you have your own story and you know when that story is going to be invalidated.
We talked about insights earlier, and obviously we do index on self-gained insights. How do you tell the difference between an opinion and an insight? Because there's a very fine line, I think, between the two.
I'm trying to think if I think the distinction is important.
It might not be.
Not to invalidate the question. I guess what I'm thinking is in markets, you can say very little with 100% confidence. There are certain things where like you could reason from first principles about like, here's how I think this market works, and like here's the structure I built, and that could at least be primarily portrayed as more insight than opinion. But so much of it is saying I had incomplete information and I came to this conclusion, and that can be 80% insight and muscle memory, and it's going to be 20% opinion. I mean, one thing that can be important is that person exposing their framework. And so you can say, if this, then machine, then X. Maybe that's a distinction of opinion is the outcome, but an insight is, well, if you believe these three things to be true, here's what I think has to happen. I could be wrong about these three things, but the insight is if this, then that. But we like opinion here. Like, I think not enough people are comfortable taking opinions.
Yeah.
And the market is a beautiful machine in that it lets you stress test your opinions, and you will be right or wrong. And you will get better as an investor if you have more opinions, you test them more frequently, and you learn why you're wrong.
You know, that is a good point. If you do have an opinion, it's really helpful with software, data, what's publicly available these days with certain pieces of, third-party things, where you can stress test it. The null hypothesis is always your opinion is wrong. But if somehow you can prove that your opinion was completely right, or not completely right, it's never easy to be completely right. But if your opinion has legs and there's correlation, the moderately strong correlation, that's an opinion that turned into an insight, but it started from an opinion as opposed to starting from this anecdotal collection of insight of if and then.
And by the time it's definitely true, it's probably a lot less insightful because now it's clear to everyone. But yeah, I'm a Bayesian by nature. And so it's always just like, I have priors, I have the information I have. What do I think is the most likely thing to happen next? And then I need to update. And I could be wrong about the priors, I could be wrong about the machine, and I should be brutally honest with myself about which one of those it is. You'd rather be wrong about the priors and get better at collecting data. But if your machine is broken, you better admit that to yourself pretty quickly and get to work on it.
You write a lot, and you share a lot of opinions as well and insights as well. Neither are better and worse than others. How did you become such a prolific writer? And if I remember correctly, and I think you told me this as an offhanded comment, but I want to make sure I'm remembering it right. So much so in a prior era that even Ray Dalio himself subscribed.
I mean, that's what I was told when I was applying to Bridgewater, because they weren't recruiting from Chicago, and someone reached out to me and said it. But again, I still don't totally get that. I don't think I really knew what I was talking about. I still don't, but I definitely didn't then. But why is, like, I'm a very exigent thinker, in that, like, and I've learned that other people aren't like this. Like, sort of for a while, I assumed everyone was like this. Like, I almost never know what the end of my sentence is going to be when I start it. Mm-hmm. I'm very much thinking out loud and like to invite others into that thought process to invalidate assumptions, to stress test the framework, to tell me where I'm wrong. This gets me into trouble at times. I can assume other people are like me and have to be reminded by my very patient wife that not everyone wants to be told when they're wrong. I'm like, but I would want to be told. Like, that's an assumption that could come back and bite me. Like, I want to know as soon as possible. It's like, well, not everyone thinks like that. But I had a great teacher in high school who's, I don't know if he coined this, I'm sure other people said it, but he really drilled it into me of like, we write to figure out what we think. And we talk to figure out what we think. And until you have to commit it, I think writing even more than speaking is more fluid. Until you put it down on paper, you don't get those sort of, it's almost like a physical nudge. You write a sentence, you're like, oh, I'm not sure that's right. I'm not like, let me go back and let me think about that. And the next sentence, and the whole thing has to hold together. And so it's a personal tool. It's not like I'd be doing it anyway because I don't know what I think yet. So I have to start writing.
I 100% agree. I've written this on my blog as well, where I write to think, and with writing, it allows you to go through revisions and the reflection process as well, which allows you to have a more robust framework in the process of discovery. Whereas when you're saying it out loud, you say it once, and obviously you can go refine it over time. But that moment in time, it's encased in amber. It's been said out loud. Somebody's heard it already. I want to talk about Opto because I think we'd be remiss not to talk about Opto. How did you first find yourself running at 8:30 in the morning with Joe Lonsdale?
That was one of those right place, right times thing. I had decided to leave Bridgewater and really, truly love my time there and have made a lot of lifelong friends and learned a ton. But a few reasons. One, I felt like the learning curve had started to level off. Like it was not, I like hard things and it was getting less hard. Two, I had started to develop a interest in the private markets because I was overseeing a lot of the high yield stuff and was like, well, it's not operating the way it used to because the marginal buyer and seller aren't meeting in high yield. They're meeting on the private side. And if you want to study the economy, you want to find the marginal buyer and seller. And it was frustrating that they weren't in the markets we could trade. And then practically, I'm a California boy at heart, and I was carrying like 8 bags of groceries back to my apartment in New York in 100-degree heat in the summer, and one of the bags broke. And I said to Isabel, how would you like to drive to the grocery store, put our groceries in the trunk, and drive home at some point? It's like, okay, sounds good. So decided to move back to the West Coast. It ended up being great timing because we were in San Francisco during the pandemic instead of trapped in our shoebox apartment in the West Village. But basically got a call out of the blue from a guy I'd overlapped with, good friend now, Zach, only about 9 months at Bridgewater together, but we sort of kept in touch. I think people who were at Bridgewater with me think I'm smarter than I am. My brain was very good at that system. It was a game that I figured out how to play very quickly. So Zach thinks I'm smart. I don't know if he still does, but he at least did then. And just called me and said, hey, I really think you and my boss would get along and you guys should meet. He was Joe's chief of staff at the time. I'd heard of Joe through like the Palantir stuff because we were Palantirs at Bridgewater, but I didn't know about APC or Adapar. I wasn't really deep in this network or community yet. And I said, sure. He said, great. He was going to run with you. I said, I haven't run in 4 years. Well, I didn't say it out loud. I said that internally and started stressing about that. So did a couple runs trying to not vomit while speaking or singing. Got to the point where I think I could not make a fool of myself and went down to Woodside and did that. I think Joe went a little easy on me. He's a pretty good runner, but I think we averaged like a 840 or 9. But the timing element of this that really worked was this was it's probably May of 2020. And so everything was locked down. We were running outside, but it also meant that Joe had way more time than he normally does. Because the world was shutting down. And so this is a guy who's normally on the road a bunch, every board, every whatever, and like found himself with free time. And I really leaned into that. And after that first run where we talked about what he had seen at Adapar, what I was thinking in terms of like a systematic approach in terms of the investing side. But, I say sometimes I've worked with 2 vaguely eccentric billionaires in my career, and they really couldn't be more different. And look, Ray is a brilliant guy. He also is like pretty aware of that. I'll put that politely. And that led to like a lot of control at Bridgewater. And again, like think the world of him as a macro investor, and like he probably was right most of the time. He was smarter than us, but Joe is much smarter than me. But if you ask him what his superpower is, it's not that; it's that he connects people and empowers them. And so it was honestly a little bit jarring at first, like 'cause I was so used to the Bridgewater kind of controlled system that he was hiring me to do this myself with whatever help I needed from him, but I had to ask. I was expecting orders and a very different setup than like just basically being told to run with the ball. And with like as much help as I wanted to ask for, but like having to be the one asking versus being the one told that I'm still missing the ball. I much prefer the Joe paradigm, and I think it lets him have as much impact as he does because he can just find people he trusts and empower them and connect them, and so you get this really awesome community of builders. And like one thing kind of adjacent to that I realized pretty quickly was like New York finance has this element of if I'm going to be right, someone has to be wrong, and so I have to hide my trades, and it's very secretive, and it's winners and losers, and like venture is just so different. It's like, well, how do we're probably more likely to win if we can win together. How do I bring more people in? How do I partner? How do I share my idea so it gets traction? And both are ways to make money. The latter to me is a lot more inspiring and a lot more fun to be a part of.
Then there's a quote that, speaking of just like relearning, unlearning, and all that, there's a quote that I recently came across that I really like. And I'm going to read it because I don't want to butcher the actual quote, but it's by Alvin Toffler. The illiterate of the 21st century will not be those who cannot read or write, but those who cannot learn, unlearn, and relearn. And I think so much of what this conversation has been so far has been through that. So before we round the bend here, what's exciting for you right now at Opto, and how can we as a society help?
One of the things that's most interesting to me is not thinking about AI overall, and there's plenty of people spilling ink, and some will be right and some will be wrong in how AI will replace, but thinking about how we make humans 10x as effective still in the loop. And so it's the empowerment piece, not the replacement piece. And one of the areas we're focused on is what does that mean for diligence, which obviously is very relevant for the LP community. Diligence is a hard human problem. It also has elements that are very repetitive, that are hard for humans. And I think we could get a lot better as investors at supporting the best ideas and the people who find the best ideas if we can utilize our data better that we have access to. And so, I mean, most people, ideas die. You pass on most things. Most of the time that dies as a PDF that's archived in your inbox. You invest in some things. Maybe you write an investment memo, maybe you don't, but that's a PDF that lives in some subfolder of some box drive, and like maybe you look at it again, maybe you don't. And to that point of like, what is the story? If we as an LP have a story of ourselves as a good investor, as a good selector of managers or co-invests, are we stress testing that? Are we looking back and saying like, well, why did I make that choice? And even if it went well, did it go well for the reason I thought it did? Is this going to stand the test of time, or did I get lucky? How am I thinking about what lucky is? Am I p-hacking, my ratios, or am I right for the reasons I think I am? On the what Ray was great at, one of the first videos you watch at Bridgewater was they had a banner year in 2012, up 38% or something. Everyone's celebrating, and he just like throws something at the board and it's like, what are you doing? We were more right than we thought we'd be. We thought we made 22%. We made 38%. Like that gap could be the other way. Like if we don't understand that gap, we're not winning. Like that's not real. Like stop patting yourselves on the back. You don't know why you made that much money. And so I think, we're working on a tool like this, but other stuff is coming out in the next few years. People will have the ability to get a lot more honest with themselves and look at a lot more data in being better investors. And if we can do that at scale, we accelerate the future. You back better ideas, you have less SBFs, and you have more real change, you have more actual movement in growth and in productivity. And, I think the dust is still long from settling on like how big of a drag AI will be on, will it hurt unemployment? Will there be a lot of people out of work? What do we need to do in terms of retraining? We're years from the bulk of the impact and from knowing the answers to those questions. But the best version of this is humans do more human stuff. That like, we look back at certain tasks that people had to do during the Industrial Revolution or during feudalism on farms, and we're like, oh God, that'd be horrible to like live your day threshing wheat like that. And like, I think hopefully we can look back on a lot of jobs that exist today that are repetitive, that I don't think can lead to human thriving, and say like, I can't believe we used to make people do that. And hopefully we find new things for people to do that is uniquely people. And so it's both ends of the spectrum of like both in diligence. I think there's a lot of diligence and screening, to go broad, that we can help humans do more human work in that seat and do less copying out of PDFs and less copy paste into Excel and less recreating same analysis, more honesty with themselves and others about how choices are made and what really drives out performance. And, by and large in private markets, what drives performance is ideas that actually matter. And if we're investing in more ideas that actually matter, hopefully we accelerate the positive side of that future versus just the cost-cutting side.
Dude, I love this so much. As one last question for you before we land the plane. And I feel like this whole episode has had a motif of humility and thoughtfulness. But as an investor who once received the mythical Bridgewater welcome packet, whose first page reads as everything you're about to read may be bullshit, what are some of the gentle reminders you give yourself of what keeps you humble today?
I have a real aversion to being like, well, Opto hit this milestone, so I'm great. I'm a great founder. Like, no, like this could all go away, or it's not because of me, or all these things. Like, if my self-worth is built on like I'm good at XYZ, it's very fragile. So if you don't need to tell yourself how good you are to feel okay with yourself, I think you do that less, and you're more open to like, maybe I'm just at the beginning of how good I can be, and I have like 18,000 things to work on, and I should be reaching out to my team and asking really frequently what I need to be doing better. Part of this is temperament of like, if you tend to be more of your harshest critic, maybe you stay on that side more. And maybe I should be more excited for myself sometimes. My wife sometimes like, that sounds like a really big deal. Like, why don't you sound happier when you tell me that news? I'm like, because like it might not have happened. And like, I don't want to be upset if it didn't happen, so I shouldn't be too excited if it does. So trying to get better about that.
Sounds like you've indoctrinated a lot of the Ray Dalio genetics of you guys have made 38%, but you only planned for 22. You've thrown something at the chalkboard like, we don't know the delta there.
Yeah, and it's just like, there's a Seneca quote. I'll do it in Latin first, just to be a pedantic asshole, but it's quod non derit fortuna non eripit, which means that which is given by fortune that which is not given by fortune can't be taken by her. Which is just a reminder of like, if you might not have gotten it, well, you might not have gotten it. And so like, don't tell yourself the story of like, well, I had to have gotten it because I'm so smart or I'm so good or all these things. Like, what do you control? What do you have outside of fortune? That's the stuff that can't be taken away.
There is no better place to end on than that. Thank you so much.
Thank you.
We'll see you soon, Superclusters. Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are 3 small things. 1, there's a little red subscribe button. If you're on YouTube, if and only if you enjoyed this episode, that's the button to click and you'll get many more presents, insights, and brilliant minds delivered to you just like this one very, very soon. 2, if you could do me a favor and let me know down in the comments what your favorite moment from this episode with Jake was. 3, it'd mean a lot to me if you could share this with one other friend you think could gain a lot from today's cosmos of insights. And also let me know down in the comments if there's anything I should have asked Jake. And if there's enough interest, we'll bring Jake back. I promised myself to record 100 episodes of Superclusters, so every comment, question, review helps me make this experience more meaningful and helpful for you, and makes investing in venture a little less scary and a lot more friendly. Lastly, I want to share a quick disclaimer. The views expressed in this podcast are for informational and educational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that we are a part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's it from me. But if you want more, this left video is something I think you'll really like, and the right one is our latest one if you haven't seen it yet.